It's that time again. Time for another episode showcasing some of my favorite interviews from the show. You're watching a special edition episode of The Income Generation. Hi, I'm David Scranton, and thanks for watching this special edition of The Income Generation. It's great to have you all here. Each week, we post brand new shows to our YouTube channel. And these shows often feature interviews with well-known financial commentators and authors, as well as retirement income specialists from across the country. But occasionally, we'd like to do an episode highlighting some of our favorite interviews over the years. For this special edition episode, we want to share with you some of the most watched interviews from our YouTube channel. And today, you'll hear interviews from investor and publisher Dr. Marc Faber, New York Times best-selling author and television host Suze Orman, investor and financial commentator Jim Rogers, as well as author and editor Harry Dent. And make sure that you subscribe to our YouTube channel at The Income Generation Show for new content each and every week. And that's where we want to bring in our first guest, Marc Faber. He's an economist, market forecaster, as well as the editor of the Gloom Boom Doom Report, available at gloomboomdoom.com. Marc is joining us now from Hong Kong. Marc, thanks for being back on the show.
Thank you for having me.
So when we spoke mid-2019, you said, there's already some sectors that are going into recession. So you were concerned about the markets being overvalued relative to the economy. Shortly after we had spoken, the Fed started lowering interest rates. But now, coronavirus and all the fallout from that. How do you see this unraveling for, first of all, the U.S. economy?
Well, I think the U.S. economy and the global economy began to weaken about 18 months ago, and there was a slowdown. But the stock market kept on going up, especially after the October low, because the Fed began to inject liquidity and its balance sheet was increasing. So that liquidity went into stocks and stock buybacks. And we went up until about February 19. And then we went down hard for many stocks, 50% in 1 month. For others, maybe 30% in 1 month. But this is a major adjustment. It's falling off a cliff.
But Marc, first of all, forget the stock market for a minute. Economically, how do you think it'll affect the economy here in the United States? Mnuchin said, could be as much as a 20% unemployment rate if Congress doesn't take action, putting us closer to a depression than a recession. Do you see that, or do you see this as ending up at the end of the day as garden variety type recession, but maybe having a bigger effect on the stock market?
No, we're falling off a cliff, and don't believe for a second officials who tell you, there is a possibility that we go into recession. We are in recession now. We are not in recession, it's a depression. Step out and walk through the street. Tell me how it looks like. In the depression, at least, you still could drink. There was prohibition, but everywhere there were speakeasies. Now everything is shut down.
So how long do you think we could go in economic stoppage due to all the isolation that we're all doing because of the coronavirus? How long do you think we can do that before things really, really elongate and get even worse? You think a 6 week stoppage? You think a 4-month stoppage? What can we weather versus what can we not weather, reasonably speaking?
Well, as you know, they have a fiscal stimulus in discussion of $1.2 trillion. I happen to think they will need $1.2 trillion every month. It's going to be very bad. I'm telling you, I've been in business for 50 years. I've never seen a situation where the economy just shut down.
Yeah, I mean, during the financial crisis, that was limited to the financial industry. And once the Fed got involved and helped that along, then it seemed like everything came back. This is truly a black swan event. And it's not a black swan event where there was a hurricane in Florida, an earthquake somewhere else, tornado in the middle of the country. It's national. So how far down do you think the stock market could go on this particular drubbing?
Well, it's like Grand Canyon. You go very deep when you walk down. And how low the stock market will go? Well, some stocks have already been hit very hard and may be in the process of bottoming. And also we're very oversold right now. So we may have a rebound of 20%. But I think, economically speaking, we're going down a valley. And the valley is U-shaped. In other words, we can't even see across the valley. And we need to be patient. We had an 11 years bull market. Do you think the bull market is all corrected in 3 months or 1 month?
Not at all.
Take 2 years.
Exactly, and that's where, and I would agree. So you're saying 2 years where things really start coming around, great. So do you think at the end of the day, from the peak of the market back in February, do you think that the market overall, let's say the S&P 500, will be down more than or less than 50%? What's your best educated guess?
I think the S&P will be down at least 50%. But 70% would not surprise me.
Okay. All right. I thought you might say that.
I don't like it because I also own shares and I own bonds and so forth. But this is now a setback in markets that is brought about by deleveraging. And we have a credit implosion and everything is going down. Until recently, treasuries were rallying. But on the government intervention, they're now also selling off. They're 15% off the highs.
That's right. The treasury yields came up. Absolutely. Now, you mentioned a minute ago, almost as if it were a good thing, the extent to which the Fed had gotten involved. But I know you always have been, and when we spoke last June, you were kind of hypercritical of the Fed, saying they had gotten too much involved. They created this asset bubble. But do you think
Correct.
The actions the Fed took a week or so ago at this point, do you think they were the proper actions? Are you in favor of that, or do you think they did too much or too little in this first phase?
I think that for years now, the Fed has essentially liquefied the system with QE1, QE2, and then Operation Twist, QE3. And since last August, essentially QE4 in the form of an intervention in the repo market. And I think the intervention in the repo market was not to help the man on the street, but to bail out some large hedge funds that may have had unfortunate positions. And I think that was all a mistake, and they're out of ammunition. In my view, certainly for the economy, they may here and there be able to boost asset prices again. But I think, again, the Fed's balance sheet would have to kind of double here to say $10 trillion.
But Mark, how about the most recent move where Fed funds rates got lowered to 0? And then on top of that, they said there's $700 billion of quantitative easing that we're going to be doing. How about that last move in light of the coronavirus crisis? Do you think that was the right move? Do you think it was too little or too much?
In my view, it is too much. And if you think clearly, we have a trigger, the coronavirus. The Fed's action will not solve the corona problem. You understand?
They're treating the symptom, not the problem, 100%.
Yes, so what they can do is solve some symptoms of the financial markets that were jittery. In other words, the market went down. But when you think about it, one of the problems of the recovery after 2008 is that as interest rates were kept low for a very long time and because of QE, leverage built up and zombie companies were kept alive. The companies and countries that should have gone bust at that time.
So let me ask you this then, because it seems like, to me at least, like lowering the Fed funds rates to zero actually has a purpose, not just to stimulate the economy, but also keeping the financial system, the banking system, from getting all gunked up. But as far as the quantitative easing is concerned, I totally agree. That's not going to help the financial system from getting gunked up. And if people are too afraid and don't want to spend, they're not going to spend just because the government floods the economy with money. Am I missing something, or are you in agreement with that?
No, you're correct. If you are not allowed to go out, if your corner bar or pub is closed, you can't spend. And also, people don't realize small businessmen who, in America and elsewhere, the service economy is huge. In other words, around the financial centers and business centers everywhere, there are hairdresser shops, there are nail polishing shops, tattoo shops, massage parlors, and all this is closing down with the stay-at-home policies.
Last question. I asked you this 6 months ago. I asked you, do you think in the next recession we're going to go negative interest rates here in the U.S.? And you said, well, I'm really not sure. And now that the Fed's funds rate is officially at zero, now that we went sub 1 until just recently on the 10-year, and even the 30-year went below 1 for a couple of days. Now, do you think, as this recession deepens, do you think we're going to go negative on interest rates here in the United States?
Well, I think it will be very difficult to drive the 30 years or the 10 years below zero because the Fed would have to come in and buy it all up. The market perception actually is quite skeptical of the intervention with fiscal measures because the deficit is already $1 trillion. Now you add another $1 trillion in fiscal stimulus. We're talking about $2 trillion, but this is minimum. You see, once they start sending out checks, $1,000 each in America, I think it will not be temporary, it will be permanent. They'll have to do it every month for the next 100 years. They'll go bankrupt before, but I'm just saying they're not going to be able to take it back.
So we need to leave it there for now, Marc. I really appreciate you being back on the show during these crazy, crazy times, and I couldn't think of a better guest. And I do have to confess that 9 months ago, when you told me on this very show that you thought that the Fed was going to start buying equities here in the U.S., I thought that was a little bit over the top. But with what's happened recently, I look back at that interview from 9 months ago and I say, you know what? I think Marc Faber was onto something. So we'll have to wait and see, and I look forward to having you back on the show again, Marc. Thank you.
Yes. Thank you.
So let's delve into the financial stuff now.
All right.
Because this is important. You start by talking about debt and being debt-free. So is there any amount of debt that's acceptable when one gets into retirement? No debt
at all. Because debt is bondage. It means you owe somebody money. And here's the problem. If they owe people money when they're retired, that means they don't have a savings account. You would owe somebody money if you had cash.
I would hope not,
right?
Sure.
You would. It makes no sense. What, you're getting 0.5%, 1%, maybe 2% if you put your money in credit unions, which I love, by the way, and you're paying 15%, 6%, 5% non-tax deductible on debt. Right. So when you get to retirement, my goal for all of you is you've paid off the mortgage, you don't have any car loan debt, you obviously are not hopefully paying your kids' student loan debt anymore, that you don't have debt. And if you have debt, you can't afford to retire.
That's right. That's right. Sometimes you have to know, you say this in the book, you have to know when to say no.
Yes.
Because even on airplane, they tell you in case of emergency, rapid decompression, put on your own mask before the mask of a child, because if you pass out, you can't help anybody else. And the same is true if you pass out financially because you haven't taken care of yourself, then you can't help your aging parents, and you simply cannot help your children. We also discussed her weekly podcast and why Suzy felt strongly about targeting it toward not just women, but also, as she likes to say, the men smart enough to listen. And by the way, your podcast, I just found out today about the second part of that podcast, and for the men smart enough to listen. And I'm glad to hear that, because I wanted to tune in your podcast, but being a guy, I was afraid that if I was on my phone trying to tune in, I might hear denied, and I wouldn't be able to tune in. But you're saying that's okay.
Well, no, what's so great is that people write in with their questions, and when a man is writing in, he goes, Suzy, I'm one of the men smart enough to listen.
I love that.
Right? So many women out there, their partner is a man. The majority of people out there. Why would I want to divide the two of them? I mean, you both have to decide about your money together.
So speaking of that, let's talk to the men and the ladies that aren't quite retired yet, or maybe they need to save more money, they need to put more money away between now and retirement. You talk about this a lot in your book. What separates psychologically, mentally, and emotionally those who are really good savers from those who are not good savers? Because the men, for example, oftentimes are afraid to tell their wives, no, we don't have the money to spend on this, or afraid to tell their daughter no, or their son no, and as a result, they just never save. So I think if we can get to the psychology of it, then we can help a lot of our viewers become better savers.
Everybody says, yes, out of fear that somebody else won't love them. You want others to love you, and you want to look like to others that you have money and everything. Here's all I can tell you is, usually you spend more than when you feel less than. That's really just that simple. If you could just stand in your truth, if you could just tell everybody if you have debt, how much debt you have. If you could just say no to your kids and to your brothers and your sisters and everything that say, I don't have the money to give you. I have more debt than you. What are you talking about? If you could just stand in your truth, you would probably start to live the most powerful life of all.
Mm-hmm. Be real, be brutally honest with yourself first and foremost, and be brutally honest with those that you love, because they deserve it, don't they?
Yeah, but I get it. When I didn't remember, I wasn't born to money. My mom was a secretary, sold Avon on the side. My dad was always sick. I get it. I was raised on the south side of Chicago. We didn't have any money. My friends all had money. I didn't. I used to steal money from my dad's pocket so I can treat my friends so they would like me. Those behaviors continue all the way until adulthood, because we just want people to accept us, because we don't think we're good enough just as we are. I'm here to tell you, you're better than you have any idea, and your money will never be what makes you good.
And next up, Suzy talks about bonds, preferred stock, and the importance of having an advisor who works with you to tailor a retirement income strategy specific to your needs and your goals, because every person in every situation is different. And in the Ultimate Retirement Guide, I was very, very pleased to hear you say that people over the age of 50, when you get in your 50s or 60s, I believe is what you said, that you should have at the very most 50% of your money in the stock market.
Yeah.
And I'm so glad to hear it, because today all these advisors, these brokers are out there with these 60-40 portfolios, which now have become 70-30 and 80-20, where they seem to think it's okay to have a majority of your money in the stock market right into retirement. And you said the common sense opposite. And tell us about that.
It depends on who you are. There will be some of you out there that you need a specific sum of income. You don't want to lock your money up. You just want control. At that point, Dave, I have to tell you, maybe 75% of your money should be in the stock market. But in what? In preferred stocks, in high-yielding dividend stocks, in things that will be safe and sound. I have a tremendous amount of money in preferred stocks. When the market tanked a little bit ago, they didn't move.
Right.
They didn't go down one bit. And I'm getting 4, 5, 6% because the danger right now is if you just keep your money in a savings account, all right, you're at 2%, you're at 1%. After taxes and after inflation, if you have to take out 3, 4, 5% a year to live on, there goes all of your money, especially if it's in a retirement account. That's been pre-tax, so then you're paying tax on it as well. So there's every single plan is individualized. There is no formula that I could give you or that Dave could give you. True. What it takes is sitting down with yourself, if you know how to do it, or somebody who looks at you not just like a paycheck. They look at you like a human being who has worked their life for this money. And they learn about you. What are you afraid of? What are you not afraid of? Can you afford to lose money, emotionally speaking? And then they map out a plan for you. But right now, I personally like dividend-paying stocks and preferred stocks more than I like bonds.
At least you can earn more.
You can earn more, and you have the possibility of growth. And even if it doesn't come to pass and they go down, if they're good quality, they'll come back, but you're getting your income. Mm-hmm. And there's, I was on some show the other day and I said, no, I wouldn't be buying bonds right now. A little bit ago, I would have bought a lot of treasuries, but now, hey, if you want your money liquid and you just want it safe and sound, all right, you can buy short-term treasuries, I don't care. But it's not going to get you anywhere. If you're looking to invest for income for this generation, it's not going to be found in bonds right now.
No, and I'm glad you clarified, because when you said preferred stock, because on the show we always talk about stock and the stock market as really being common stock.
Yeah.
I tend to lump preferred stocks for purposes of simplicity in the universe of what I call bonds and bond-like instruments.
Yes, they're bond-like instruments. Yeah. But right now they're actually, in my opinion, better than bonds, because some of them, when they come to market, like I said, they're at 4, 4.5, 5, 6% yields. Mm-hmm. That's a big deal. That's a big deal. So I like them a lot.
Right now it's time to welcome my good friend and co-host Jeff Small, president of Arbor Financial Services, a retirement income store located in Melbourne, Florida. Jeff's also the Amazon best-selling author of the book, Turning Financial Planning Right Side Up. But we also want to bring in our first guest, a good friend of the income generation, Harry Dent. He's the author of 0 Hour and the editor of Economy and Markets, a free newsletter available at harrydent.com. Harry, thanks so much for being back with us on the show, and Happy New Year.
Yeah, glad to be here, David.
So, okay, I know you were thinking there'd be a pretty good pullback in the markets, maybe as much as 40% or more, even in 2020. And I was concerned also for a good part of 2020, but it seems like the market's trying to make a liar out of both of us. So what do you see moving forward now in 2021 regarding the markets?
Well, it's just politics as usual, where, especially transitioning here from presidents and everything, everybody wants to keep the economy up and looking good. Trump wanted that $2,000 stimulus check to make sure it didn't fall apart just as he's leaving office, which he gets blamed more for. And of course, Biden wants as strong as possible. But again, the markets are getting stretched. And what I've seen really quick, David, ever since the first bubble peak in early January 2018, every correction has gone deeper and every new high has gone higher. And this is the last new high I see. And the next correction on the S&P would be about 44%. We're at almost 3,800 recently, and I'm projecting 2,100 by the middle part of next year, June, and perhaps as early April.
What do you think's going to be the next actual trigger, though, that causes that?
Well, we just kind of saw it a little bit this morning. ADP comes out, payrolls are less than we thought. Yeah. People don't get that this economy's been stretched and stretched and stretched. And we've had the greatest stimulus ever in the last year. I mean, 3.6 trillion in monetary stimulus in about a year since the repo crisis. And now 3 trillion in rising in fiscal stimulus. This is 35% of GDP that's just been given to the economy. Of course, they're replacing a short-term depression, and you can't keep doing this. I mean, the deficit's 3 trillion plus this year, going to be 4 trillion easily this year. And you can't keep doing this. It costs so much. So I say what happens here, the economy keeps weakening despite the stimulus. It's pushing on a string after a point. You can only get people to refinance their homes at lower rates so many times. You can only pump up them to spend more when they don't need much and their kids have left the nest. So I think the economy keeps weakening into February, March, the first quarter. And then the stock markets, which is so highly valued, and real estate finally said, well, wait a minute, it doesn't really seem to matter. We just saw the biggest stimulus program by far in history, and we're already weakening again. And that's what I've been saying. It takes escalating stimulus exponentially more to get less and less, diminishing returns, well-known concept in any addiction or growth process.
Well, you know, Harry, you're right. We are pushing on a string, and that string is getting really, really thin. But looking at the market charts today, I mean, it's clearly we're in a bubble. Valuations are stretched. We're going to face some challenges going forward. And now we've got this new political theater action going on. It looks like the Senate's going to be blue.
Well, you know, what's happening now, and this is why the market, I mean, we're talking on Wednesday here, and we get this news of 2 Democratic senators likely, you know, coming in, which is going to take away McConnell's power substantially. And what do? The NASDAQ is down 1.5%, 2%, and the small caps, the value stocks are up 2 to 3%. Well, it's saying we're switching more from monetary stimulus, which favors all financial assets, especially the most highly valued, which means the tech stocks, and into fiscal stimulus, which actually goes into the economy and the consumers and businesses rather than just into pumping up financial assets. So that's the shift here. So the Democrats think, okay, yeah, we're going to get more fiscal stimulus, but the Fed is going to use this as an excuse.
Going back to the pushing on the string type theories, you know, I see us going forward in the economy using a China money management or financial engineering style of just money printing endlessly. We're going to open up the checkbooks. They're going to buy equities if the market crashes. They're going to keep interest rates low. How can the government ever raise interest rates? How can the Fed ever raise interest rates when there's this much debt? I see interest rates being low forever.
Well, they're going to do it until the markets raise interest rates because of default risk, first in business, and then at some point. I'm projecting in my most recent newsletter a $40 trillion government debt in the U.S. by 2024, because we just had $3 trillion, add $4 trillion a couple of years, and after that, this happens quickly. So the markets will take care of this. But near term, interest rates are going up a little bit, late stage inflation on the treasuries, 10-year and 30-year treasury, which is important because that is the safe haven in the downturn. It was in 2008. It will be now. It will not be gold. Gold will go up at first. But when you see deflation and companies failing like Lehman Brothers in mid-2008, interest rates are going to go down, Jeff, because of deflation in prices, negative consumer price inflation, not just because of stimulus and buying bonds to push their rates down. So I see the 10-year maybe going up to 1.25 here. It's already up above 1% on Wednesday here, and then going down to 0 or negative 30 years from 1.7 or 8 down to 0.5% or lower. And people say, well, how can you make money on a bond that low? A 30-year treasury bond, if it goes from 1.7 down to 0.4, which is my best calculation, will appreciate 40% while stocks and everything's crashing. In the one thing the U.S. government will make sure to make their payments, they will not screw their own bonds, okay? They'll let the stock market crash, but they're going to pay off their bonds short-term and long-term. And those rates are going to go down and favor them for a while. So this low interest rates is artificial, but we're also in a longer-term era of low inflation because of slowing population growth here and around the world. So even when we go in the next boom, we're not going to see inflation go up to 15% again. We might see inflation get back up to 2, treasury bonds up to 3 or 4.
Harry, will we see negative interest rates here in the United States?
I think you could. I think you're going to see that or close. I do think the 10-year treasury, which is the benchmark for stock valuations and lending and everything, is going to go down from about 1% today to around 0. It could go negative. I don't think the 30-year goes negative, and that's the bond to buy because it will appreciate the most in deflation because of the longer duration and the higher rates to start. But yes, I do think we're going to see 0 or negative, and we're the last country. Japan and most of Europe already had negative rates.
Yeah, it's funny. You're the first economist that we've had here who actually says it's possible for negative interest rates. Jeff and I believe it's possible, but most of our guests have said they don't believe it is. So I tend to side with you. But you know, our viewers and listeners are they're retired or near retirement. So when we get this big stock market drop that you're looking for, how long do you think it'll take before things come back? In other words, how long will the market be underwater? They need to know that.
Yeah, you know, it's classic. This is like the 29 to 32 crash. The 90-year cycle is the most important cycle. Nobody sees it because it's so long. This is 29 to 32 happening all over again. Stocks are going to go way down, so you wait and you buy them when they're down. I am projecting and have all the way back to late 1980s, projecting the bottom of our lifetimes in stocks would occur at the end of 2022. So that's about 2 years from now, okay? Because there's a lot of cycles that play into that. But once you peak, like we did, started to crash in February of 2020, the Great Depression stock crash took 34 months from top to bottom, almost 3 years. So that would be from February of 2020 into late 2020 to December 2022 would be my best time. That's when you look for a bottom. And I've got a target on the Dow. It's scary, 5,000. When you see 5,000 and or December 2022, that's when you look to buy stocks again. Until then, get in the safest AAA corporate bonds and the 10 and 30-year treasury, particularly the 30-year. Because and you're going to not just get tiny interest, you're going to make money. It's the only thing that goes down when real estate, commodities, and stocks, all other financial assets, including gold at some point, will go down in this sort of reset. You got to remember, this is an unprecedented bubble, only once in a lifetime, every 80 to 90 years, and there is no safe investment other than really safe investments. So you have to protect your money first, and by being in those safe bonds, the appreciation on those bonds is going to give you far more income than the measly 1.7% on that 30-year treasury.
Yeah, well, of course, when you get to 30, you're right, the 30-year is the one that's going to appreciate the most when interest rates go down. So, Harry, it's been our pleasure. It's great to get your views as usual. And thanks so much for being back with us here on The Income Generation. And now it's time to bring in my good friend and co-host, Jeff Small, along with our guest, Jim Rogers, American businessman and financial commentator. He's also the chairman of Rogers Holdings and Beeland Trust Incorporated. Jim, thanks so much for being back with us here on The Income Generation.
I am delighted, David. I'm a fan.
Well, listen, it's you know, last time we spoke, the economy was doing well, the markets were doing well, and some things still look good on the surface. But as you know, the topic of today's show is really resetting your retirement in light of this, essentially, this coronavirus crisis. So talk to our Income Generation members, those retired or within 10 years of retirement, and tell them what things you think they should be considering, or if they should be considering resetting their retirement in the light of what's going on now.
Well, David, you need to do a show on resetting your life. This has changed just about everything, whether you're 17 or 77. You better reconsider a lot of things, including retirement. Well, the first thing, of course, is interest rates are zero or nearly zero. So as far as getting yield, it's very, very difficult. I urge people not, I mean, right now, junk bonds are going through the roof because everybody's so desperate for yield. It's better to earn 1% a year than to lose 4 or 5% a year. And if you don't know that, try it and you'll find out. So I would urge people to be careful of junk bonds and taking risks that they don't understand, because this is not going to last forever. We are going to have interest rates again in the world.
Up until recently, we've had a pretty long period, maybe 7 years or so, with not a lot of junk bond defaults. And it's possible that investors have gotten overly confident, maybe borderline cocky, thinking, well, junk bonds are still pretty safe. But with the corporate bankruptcies we're seeing right now, clearly that's not the case anymore, right?
David, what you just said, things are different this time. They're not ever different this time. Yes, it's been 7 years and people think, everything is okay. That just makes it worse. Do not get overconfident, because the world has not changed that much, and we will have defaults again, and we will have interest rates again.
Sure. So what, somebody who needs income then, what do you think? Maybe if you go to high dividend yielding blue chippy type stocks that maybe their bond issues would be, triple B or higher. They'd be investment grade, maybe even A-rated, but you're getting a better yield on their stocks than you are by their bonds on a by a long shot. Is that what you'd consider for income, perhaps?
Well, yes, David, if you know what you're doing, but don't go let somebody say to you, oh, this stock is yielding 3%, buy it. And you don't have a clue what it does, or you don't have a clue what the business is, or whether it's good value or not. No, I mean, there's nothing worse than investing in something you don't understand, because it has nearly always, at least in my case, it has nearly always led to problems, if not disaster. So be careful. I know it's difficult times. Don't think I don't have the same problem. We all do, but don't overreach and make mistakes.
Yeah, that's a chapter right out of Berkshire Hathaway. Chapter right out of Warren Buffett's words, essentially. I know Jeff's chomping at the bit to talk to you about China and some questions there. Before we do that, though, I have to ask you one more thing. You intimated a moment ago that you thought at some point interest rates would go back up again. And I'm in the camp that we're in a new normal of excessively low interest rates with all the world's central banks flooding the markets here. So if you do think rates are going to go back up, I mean, how high and why? Talk to us about that.
Interest rates have never been this low in recorded history worldwide. This has never happened before. And maybe the world has changed dramatically, but governments everywhere are spending huge amounts of money, borrowing huge amounts of money, and printing huge amounts of money. Throughout the history of the world, those kind of conditions have ultimately led to currency debasement and higher interest rates. Maybe it won't this time. Maybe now everything is different, but it always has in the past.
So is it possible then that what we've seen this time lately, over the last 7 or 8 years, is not so much currency debasement and inflation of costs of goods and services? Alternatively, we've seen inflation, asset inflation, because baby boomers aren't spending the money. They're saying, I've got to save this. I've got to put it in the bank and I've got to invest it. And therefore, all the assets have gone up. So, to me, it seems a decent chance that we might continue to have asset inflation, even though maybe things are overinflated already, because people just aren't buying goods and services quite to the level they were as they get older. And am I off base in your opinion, or any truth to that?
We are seeing asset inflation. Bonds are the highest they've ever been in recorded history all over the world. American stocks are making all-time highs. Look out the window. We're having asset inflation in most parts of the world. It's happening. Can it continue? As long as governments print huge amounts of money, they are showing us a good time. Will that last forever? To repeat, historically, it has not lasted forever. Historically, people say, wait a minute. We've seen this movie before. We want out. And I don't know when. You can watch your show to find out when, but it's not going to last forever.
So, Jim, it's great to see you on the show. I guess you're in Singapore right now. That's your home base. So you've got a unique Asian perspective. We're looking at a potential political change here as we go through the strife over here domestically in the United States. And if we have an administration change, we're going to see trade risks probably diminish. So if that ends up happening and trade risks do diminish, what Chinese stocks do you like that could benefit from a change in administrations in that regard? Tell us what some of your picks are, what you like going forward if that happens.
Well, Jeff, you know what's happening in the world, and anything to do with travel, tourism, transportation, restaurants, hotels, they've been smashed. So I, anyway, am trying to find things in China, since we're talking about China, that have been smashed. I've bought Chinese wine companies recently. People don't go to dinner. They don't go to the bars. They don't go to the discos. So wine, needless to say, is down a lot. Most people still haven't heard of Chinese wine companies. I hope someday I hope you and I, Jeff, someday are sitting in a restaurant drinking Chinese wine.
So, Jim, there's lots of promising vaccine trials going on here, the best results that we've ever seen in a stage 1, stage 2 trial. It looks like we could get a hold of this coronavirus with vaccines and therapeutics before the end of the first quarter of next year. And so what type of effect would that have on global markets, since you've got kind of a Singapore perspective? And what is your downside scenario forecast for if the virus gets worse and the vaccines don't come to light? Give us your range of the good, the bad, and the ugly here on what you see happening.
Well, if there's no cure, if there's no solution, be very, very worried about 2021, because no matter who's elected in the US, the world is going to have serious, serious problems. If somebody comes up with something, and lots of people are working, it will probably cause, for instance, emerging markets to have big rallies. They've been hurt very badly. I mentioned sectors before, like travel, tourism, transportation. All of those areas will have huge revivals. You know, in many parts of the world, I live in Singapore, the airport's basically closed. So if there's a vaccine, the airport's going to open and it's going to be a boom compared to present situation, that is.
No, I agree with you. I mean, it's the same story over here. You know, international travel is gone. Domestic travel is down to about 20% to 15% of what it was prior to the vaccine. So we're just kind of waiting for this stuff to come on deck. But it looks promising so far. So we'll have to see what happens in stage 3 with some of the trials we have going on into the late fall.
Well, we all hope, obviously, we all live in the same world. Let's hope that we can go back to some kind of normality again. We'll hope that we can all have a great time and make some money again.
Jim, what do you think about what's happening right now? Our relationship with China seemed to be getting better for a while as we're trying to get a trade deal done of sorts. And now it seems like the United States is going a little bit more isolationist when it comes to China. And of course are blaming really intellectual property security as the reason for that. Do you think there's validity to that? And if so, do you think we're doing the right thing? I know you're not an isolationist guy, you're quite the opposite. So talk to us about that.
Well, there have been periods in world history when the world has closed off and periods in world history when we opened up. I hope we continue to open up. The Chinese certainly opened up for the last 40 years. Now even the Chinese are closing off to some extent. The Republicans have said out loud many times they're going to use bashing China to win the election this year. Whoever wins, I hope that in December and January, people start saying, okay, now we've done that. Now let's try to have some prosperity again and open up. Open economies and open markets. I mean, history has shown repeatedly that's better for the world than closing off. So
let's say that doesn't happen, and you're talking about buying Chinese companies, buying stocks in Chinese companies. Do you think then that in this, if there's essentially a financial Cold War, you know, is this something that China can fare well, or because U.S. has really a bigger economy in many ways that they can perhaps, you know, maybe if this continues, then our Chinese stocks really could have the potential to be a good investment, or could it turn the other way for them?
David, trade wars have never been good for anything. One of the things that history shows is nobody wins trade wars, and trade wars are not good, and they sometimes lead to wars. Unfortunately, that doesn't mean people don't try them. They think they can win a trade war. One of the main lesson of history, David, is people don't learn the lessons of history. You know, history will teach us that. I would hope that somebody will come to their senses in China and the US, and we will all open up. But it's not just the Chinese. I mean, Mr. Trump is bashing the Japanese and the Germans and everybody in sight. My reading of history, that is usually not the best way to go. I hope that after the election, he did huge amounts of business in China before he was president. I hope he opens up again.
Yeah. Well, the question is how much of it's political versus how much is a real concern. If it's all political, then no matter who gets in, you're right, things should turn back in the non-isolationist direction. So Jim, we need to leave it there for now. Thanks so much for being up this late at night from Singapore to interview with us. We really appreciate you being here once again. Thanks for watching the special edition episode of The Income Generation. I hope you've enjoyed some of our most watched interviews, all right here on our YouTube channel. And make sure that you subscribe to our channel at The Income Generation Show for new content each and every week.